Okay, imagine this. You're right at the finish line of a huge financial audit. The teams have crunched all the numbers, they've gone through stacks of documents, everything seems pretty much set. But there's this one final, really critical stage. It happens right before the auditor actually signs off. And it's more than just catching typos or simple math mistakes. It's actually a pretty complex process, guided by some very specific professional standards.
Absolutely. It's a crucial step.
So for this deep dive, we're going to unpack exactly that moment. How auditors evaluate these things they call misstatements in financial reports. Our mission really is to pull back the curtain on ASA 450. That's the international standard on auditing that kind of sets the rules for this evaluation.
That's the one. It's a main guidance here.
We'll get into what actually counts as a misstatement, the different kinds an auditor might find and what they have to do when they find them. And I think you'll see why this stage is just so vital for trusting the financial statements you read. And also why sometimes things that look small, well, they can actually be a really big deal.
They really can. Size isn't always the only factor.
Okay, so let's dig in. When an auditor says, we found a misstatement, what exactly does that mean in an audit context?
Right. Well, according to ISA 450, fundamentally, a misstatement is when something in the financial statements hasn't been treated correctly. Basically, the rule book, the applicable financial reporting framework, like IFRS, often it just hasn't been applied properly.
Okay, so it's about following the rules, essentially.
Exactly. And these aren't just like abstract ideas. They show up in very practical ways. So you could have an incorrect amount. Maybe an asset isn't valued quite right according to IFRS. That's a common one.
Like a calculation error or using the wrong valuation method.
Could be either, yeah. Or you might see incorrect classification. For example, maybe a finance cost gets sort of hidden in the cost of sales instead of being shown separately as a finance expense.
Ah, okay. So it affects how you read the income statement.
Precisely. Then there's inappropriate presentation. Maybe the results from a part of the business they sold off a discontinued operation aren't shown separately like they should be. Makes it harder for users to understand the ongoing business.
Right. You want to see the core results clearly.
And then there's incorrect or misleading disclosure. This one can be particularly tricky. It could be, say, a really important potential liability, a contingent liability that's just missing from the notes altogether. Or maybe it's described, but in a way that really downplays how serious it might be.
And that sounds like it could stray into tricky territory, like management bias.
It can, yeah. Sometimes these disclosure issues might suggest management is trying to present things in a perhaps overly favorable light.
That's fascinating. So a misstatement isn't always just, a simple math mistake like I first thought. It could be how something's presented or classified or even something left out entirely, which makes me wonder, are these always just honest mistakes? Or can they sometimes be, more deliberate, maybe even fraud? How does that possibility factor in?
That's a really critical point. Misstatements can come from either error, genuine mistakes, or much more seriously, from fraud. And if an auditor starts suspecting fraud, well, that changes things dramatically. It triggers a whole different set of procedures, deeper investigation. It can really alter the whole audit approach.
Right. It raises the stakes considerably.
Definitely. ISA 450 helps guide the auditor's response in both scenarios, error or potential fraud.
Okay, so let's say an auditor spots one of these issues. Maybe it's a valuation error, maybe it's a misleading note. According to ISA 450, what's the immediate next step? What's the first thing they have to do?
Well, the first requirement is that the auditor has to accumulate misstatements identified during the audit, other than those that are clearly trivial.
Accumulate. Okay. And clearly trivial, what does that mean?
A good question. Clearly trivial means the auditor sets a specific monetary benchmark, a threshold. Below this amount, misstatements are considered so small, so insignificant, that even if you added them all up, they just wouldn't have a material effect on the financial statements.
So like genuinely tiny amounts, pennies almost.
Pretty much, yeah. Items that are truly inconsequential. These don't need to be tracked or even mentioned to management. But, and this is really important, clearly trivial is not the same thing as not material.
Ah, okay. Explain that difference. That sounds crucial.
It is. The standard is very clear. Clearly trivial is a much, much lower bar than materiality. Think of it as, completely inconsequential. Materiality is about whether something could influence the decisions of someone reading the financial statements. Clearly trivial is far below that.
Right. So something could be not clearly trivial, meaning the auditor has to track it, but it might still end up being considered not material in the grand scheme of things.
Exactly. You've got it. And deciding what's clearly trivial involves quite a bit of professional judgment. Factors like the overall audit risk can definitely influence where the auditor sets that very low bar.
Okay, that distinction is really interesting. Clearly trivial versus not material, it highlights that judgment element. So once they've decided something isn't trivial and they start accumulating this list, what's the next step? How do they interact with the company about these findings?
Right. The next step is communication. And timely communication at that. ISA 450 says the auditor shall communicate on a timely basis all misstatements accumulated during the audit with the appropriate level of management. And then, critically, the auditor shall request management to correct those misstatements.
So basically, keep a running list, tell management promptly, and ask them to fix the issues.
That's the essence of it, yes.
Yeah.
Like creating a punch list for the financial statements that need adjusting.
Okay. Now, I understand ISA 450 actually breaks these misstatements down into different types.
It does. There are three main categories, and distinguishing between them is really important for having effective discussions with management about correcting them.
Makes sense. What are they?
Okay, first up are factual misstatements. These are the straightforward ones. Misstatements where there's really no doubt. It's a clear breach of the rules, like IFRS. The numbers or the disclosure are just plain wrong.
Like finding 2 + 2 = 5 in the ledger.
Exactly like that. Or say a listed company that's required to disclose earnings per share, but it just hasn't. There's no room for debate. It's simply incorrect according to the standard.
Got it. Black and white, easy enough, presumably, to get those fixed?
Generally, yes. With factual misstatements, there's little negotiation. It's just wrong, needs correction. Then the second category is judgmental misstatements. Now, these are a bit different. They come from differences between management's judgments and the auditor's judgments, things like accounting estimates, or maybe the specific accounting policies management chose to use or how they applied them. The auditor looks at management's judgment and concludes it's unreasonable or maybe inappropriate.
Oh, okay. So this isn't about factual errors, but differences in opinion on subjective areas.
Precisely. Think about things like estimating the fair value of, say, specialized property, or deciding exactly how much detail is needed when disclosing a contingent liability, or even assessing how likely it is that customers will actually pay their bills, the recoverability of receivables. These all involve significant judgment.
That definitely sounds more nuanced. If it's a factual error, it's easy, fix this. But if it's a difference in judgment, how does an auditor approach that conversation? It's not like saying you're wrong. It's more like we see this differently based on our assessment. How do you push for a correction there?
You put your finger right on the challenge. It's definitely a more delicate conversation. The auditor can't just say, we don't like your estimate. They need to back it up. They have to present their own conclusions, supported by solid audit evidence, explaining why they believe management's judgment is unreasonable or inappropriate in the circumstances.
So it's about building a case based on evidence.
Exactly. It becomes a discussion based on professional reasoning, evidence, and interpretation of the standards, rather than just pointing out a clear mistake. The goal is to persuade management with the weight and logic of the audit findings.
Okay, that makes sense. So we have factual, judgmental. What's the third type?
The third type is projected misstatements. These arise when auditors use sampling. So an auditor might test, say, 100 invoices out of a population of thousands. If they find errors in those 100, they might extrapolate or project those errors across the entire population to estimate the total likely misstatement in that whole group of invoices.
Right, like saying, based on this sample, we estimate there's roughly this much error in the whole balance.
Exactly. It's the auditor's best estimate of the misstatement in the whole population based on the sample results. Now, here's a key point about projected misstatements. The standard says it is normally not appropriate for management to be asked to correct these specific amounts directly.
Oh, interesting. Why not? If you estimate there's an error, why not ask them to adjust for it?
Because it's an extrapolation, an estimate based on a sample, not a specifically identified error in the remaining population, asking management to book an adjustment based purely on a statistical projection is generally seen as inappropriate.
So if management isn't asked to correct these projected amounts, what happens with them? What's the purpose of calculating them?
Good question. Instead of asking for a direct correction, these projected misstatements are evaluated primarily to see if more audit work is needed. If the projected misstatement is large, it might suggest a higher risk of material misstatement in that area, prompting the auditor to maybe expand their sample size or perform different tests. It's more about assessing risk and guiding further audit effort than about booking a specific adjustment.
Got it. So it informs the audit strategy going forward.
Precisely. It helps the auditor gauge if there might be a wider issue that needs more digging.
Okay, so auditors find these misstatements factual, judgmental. Maybe they estimate some projected ones and they communicate them to management, requesting corrections for the factual and judgmental ones. But what happens if management pushes back? What if they say, no, we're not correcting that?
That definitely happens. Management is expected to correct misstatements, but they might refuse. If they do, ISA 450 requires the auditor to really understand why. What are their reasons for not correcting? And understanding those reasons is important because it feeds directly into the auditor's overall evaluation, their big picture assessment of whether the financial statements as a whole are free from material misstatement. Management's refusal becomes part of the evidence the auditor considers.
So it influences the auditor's final judgment.
Absolutely. At this stage, the auditor has to look very carefully at any uncorrected misstatements, the ones management refused to fix, and determine if they are material. Not just individually, but also when added together, in aggregate. And this often involves another crucial step, reassessing materiality itself.
Reassessing materiality, you mean the benchmark they set at the start?
Exactly. Think about it. The materiality level set during the planning stage of the audit is usually based on draft or projected financial results.
Right, because the final numbers aren't ready yet.
Precisely. But by the time the audit is wrapping up, you have the actual financial results. Those actual results might be quite different from the initial projections. Maybe revenues were lower or profits higher. So the auditor needs to look at that initial materiality threshold and confirm it's still appropriate given the final actual numbers. Their yardstick for what's important needs to be relevant to the reality of the company's performance.
That makes a lot of sense. The context might have changed.
It often does. So that reassessment is key before making the final call on the uncorrected misstatements.
Okay, so we're talking materiality, mostly in terms of dollar amounts or thresholds. But I recall you saying earlier that sometimes a misstatement might be below that monetary threshold, but still considered significant. How does that work?
That's right. This is where qualitative materiality comes in. Some misstatements can be material for reasons other than just their size.
Qualitative factors, like what?
Well, think about a misstatement, even a small one numerically, that causes the company to violate a regulatory requirement. That could have serious consequences regardless of the dollar amount.
Okay, yeah, compliance issues.
Or imagine a small misstatement that allows the company to just barely meet its debt covenant requirements. If correcting it meant they'd violate the covenant, well, that small misstatement suddenly becomes hugely significant because of the potential impact, like the loan becoming repayable immediately.
Wow, okay. That could be massive.
Definitely. Other examples could be misstatements that obscure a change in earnings trends, maybe hiding a decline, or ones that affect key ratios that analysts use to evaluate the company.
Or maybe even something that bumps up management bonuses.
That's another classic example, yes. If a misstatement impacts management compensation calculations, it gets scrutiny regardless of size. Or one more maybe, it relates to misapplying an accounting policy. The impact this year might be small, immaterial. But if that incorrect application continues, it could become material in future years. That future impact makes it qualitatively significant now.
So the auditor has to think beyond just the current year's numbers. It's about the broader context and potential repercussions.
Exactly. It's detective work, looking at the implications, not just the numbers in isolation.
Okay, so the auditor has accumulated the misstatements, discussed them with management, considered materiality both quantitatively and qualitatively. What's the next communication step, especially regarding the ones management didn't correct?
Right. The communication continues upward. The auditor is required to communicate all uncorrected misstatements to those charged with governance.
And just to remind everyone, those charged with governance, that usually means the board of directors or perhaps the audit committee of the board, right? The top level of oversight.
Precisely. It's that highest level of oversight within the company structure. The auditor lays out the uncorrected misstatements for them, specifically identifying any they consider material, individually or in aggregate. And again, formally requests that they ensure the corrections are made.
So the buck stops with the board, essentially. What if they also decide not to correct the misstatements, even the material ones? What happens then?
Well, that's obviously a very serious situation. If those charged with governance also refuse to correct material misstatements, the auditor needs to have some very frank discussions with them. They'll discuss the reasons why, the potential implications for the company and its stakeholders, and crucially, the impact this will have on the auditor's report.
The The audit opinion.
Exactly. Because if material misstatements remain uncorrected in the financial statements, the auditor cannot issue a standard, clean, unqualified opinion. It's highly likely to lead to a modified opinion, either a qualified opinion, except for these issues, the statements are fair, or potentially even an adverse opinion. These statements are not fairly presented.
So disagreement at this level has direct consequences for the audit report everyone reads.
Absolutely. It's a major red flag. Alongside these discussions, there's another requirement. The auditor needs to get a written representation from management, and sometimes from those charged with governance, too. Basically, a formal letter.
What does this letter say?
It confirms management's belief that the effects of the uncorrected misstatements, the ones the auditor identified but weren't fixed, are immaterial, both individually and when added together to the financial statements as a whole.
So management has to formally state, in writing, that they believe these outstanding issues don't matter materially.
That's right. It's a formal acknowledgement from them, putting their assessment on record, even when the auditor might disagree on the materiality.
Okay. And finally, what about the auditor's own records? What do they need to document about all this?
Documentation is key, as always in auditing. ISA 450 specifies what needs to be in the audit file. This includes the auditor set below which misstatements are considered clearly trivial, a record of all the misstatements accumulated during the audit except the trivial ones, and whether or not they were corrected. And crucially, the auditor's own conclusion about whether the uncorrected misstatements are material, individually or in aggregate, and the reasoning, the basis for that conclusion.
So that documentation trail is vital. It shows the work done, the judgments made. It basically forms the backbone supporting the final audit opinion.
Precisely. It demonstrates the whole process, the rationale, and the basis for whatever opinion is ultimately issued.
Okay, so wrapping this up, we've really gone through quite a journey here in this deep dive, from spotting those initial potential misstatements to figuring out if they're factual or judgmental or projected.
Right. Those categories matter.
Then having those sometimes tricky conversations with management. Evaluating the impact, both quantitative and qualitative, and finally deciding how it all affects the big picture, the financial statements and the auditor's own report.
It's a rigorous process for sure.
And I think what comes through is that this detailed evaluation, this whole ISA 450 process, is what provides that reasonable assurance. We rely on the assurance that financial statements are free from material misstatement. It's what gives users, confidence in the number.
That's the goal, to enhance the degree of confidence.
It really shows the layers of scrutiny involved in reaching that final audit opinion. It's not just ticking boxes.
Not at all. There's a huge amount of judgment involved.
So maybe a final thought for our listeners. The next time you pick up a company's audited financial report, just consider this. Beyond the neat colors of numbers, how much does the auditor's professional judgment, those careful back and forth discussions with management, and their understanding of those subtle qualitative factors, how much does all that shape the very opinion that gives you confidence in what you're reading? It really is far more than just a rubber stamp, isn't it?
It certainly should be. There's a lot going on behind that signature.